Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, September 9th. Green week, green tie. Nice turnaround this week. Tuesday, coming off Labor Day weekend, midday we're down about 1.5% or so on the S&P. Had a nice rally straight across most sectors. You know, volatility is a term that gets tossed out there, but what we're seeing right now is real whip in the market, and there is a difference between a volatile market and a whippy market. If we go back to last Friday, before Labor Day weekend, I realized that it's going into Labor Day weekend and volume historically is quiet. But noon on Friday, Dow Jones is up 300 points. At 1:30, it's down 300 points. Now, you can come up with some different headlines and so forth, but that amount of movement on really scarce volume really tells you what you need to know about that term you hear on trading floors called whip or whippiness in the markets. And that's what we're seeing in the equity markets. Even this week, we had 3 different periods where markets were going from up 1% to down 1%. Again, that's not the norm. So we're bracing ourselves for some more of that. You're seeing the Fed trying to dampen volatility, trying to dampen inflation, and that's going to increase volatility as they pull liquidity out of the markets. Now, you can say it's just in the fixed income market. There's reverberations in all markets. Equity, fixed income, commodity markets work together. When you go a step further and take a look at those markets as they pertain to the options markets and to the futures markets, you can really start to see where that whip and volatility comes from. Now, some of this move this week higher was on the back of what we touched on in our meeting Tuesday morning here at Cumberland, and that was enormous put buying by institutional investors last week. Enormous. You heard me previously, really for the last few years, talk about looking at the speculative, the small spec options player and trying to take the other side of those trades because they tend to get emotionally involved in the up market, chasing, and the down market, panicking. Institutions are a little bit different. So we give a little bit more credence when it's institutional, and we define that by the size of the contracts in the options market. When we see that kind of put buying, we naturally want to take the other side of it, but not as aggressively as we would want to on the spec or small size options player. So the last time we saw that kind of put buying by institutions was all the way back in 2008. So got it right once or twice, got it wrong once or twice, the put buying. So there was areas where it preceded weakness in the market, where money was made by buying puts, but there was also some nasty reversals with large put buying preceding it. So not a lot to go on there. We just wanted to go back to what we've talked about over and over again, and that's positioning. It's not the news. It's not what comes up that day. It's how the markets are positioned going into that news. And maybe what the Fed had to say midweek just wasn't as negative as people were positioned for. So we got a little bit of a move higher. I wouldn't call it a rip. I thought the market had an opportunity to rip higher if it wanted to, if it could. But a good steady pace. We'll see if that carries on next week or if it's been like we've seen the previous 2 or 3 weeks where strength is sold. So we're going to go over to the Moose now. Toss it to John. What do you have for us, John?
Hi, it's John Mousseau. It is Friday afternoon on September 9th. I'm the CEO and Director of Fixed Income at Cumberland Advisors. This week in bonds, yields higher across the board. 356 on the 2-year, 345 on the 5-year, 332 on the 10-year, and 346 on the 30-year. Important point, shorter end up about 17 ticks, longer end up about 9 ticks in basis points. What does that say? That says that the Fed officials, ahead of the Fed meeting this month, are out front and center saying how really hawkish they are on raising short-term interest rates and really putting on a unified front, I would say, about trying to battle inflation expectations. Interestingly enough, when you look at it, we know that the 2-year to 10-year yield curve is still inverted. That's a 356 to a 332. And going out from 10 years to 30 years is positive, 332 to 346. The 2-year bond at a 356 is basically almost 10 basis points higher than the 10-year bond was at its peak last June. So it tells you that short-term yields, Fed basically making statements, is operating in a different sphere than intermediate and longer-term rates. We expect this to probably continue to happen. Muni yields this week off about half of Treasuries. A pretty decent week for munis on a relative basis. But what you've seen is muni issuers come to market and they're just bringing the deals cheap. We continue to like the longer end of the market. We see plenty of municipal bond deals at 4.5% or higher. You can do the math when you're in a high tax state and add that on to a top rate of 37%. Now you're talking about taxable equivalent yields for long munis that are well over 8%. And we think that is super attractive. And remember, you do this with the idea that you're not viewing it in today's inflation world. You're doing it in where you think inflation will be down the road. Whether that's 2%, probably not. Maybe 3 is the new 2, but clearly less than we are experiencing now. And we continue to see some of those soft points out there, whether it's in real estate or commodities, or you're starting to see some job cuts in certain places. And some of this is just, percolating below the surface in certain cases. But you're starting to see foreclosures pick up. You're starting to see installment debt on credit cards pick up. We think this is all leading to some softening in the economy as we go forward. And, certainly as you get towards the end of the year, if the Fed raises 75 basis points at their next meeting and another 75 after that, now you're starting to close in on 4%. And, I think the markets will start to take a cue from that. So we continue to barbell portfolios, shorter term and longer term. And you got to remember, when you're doing that, you're really working in basically 2 different football games. The short-term yields, we want to keep those maturities short because yields keep creeping up higher. And longer term, we want to lock in those 4% plus on the muni side. And on the taxable side, stuff that's coming, 200 basis points over Treasuries, we think is very attractive. Very somber weekend, 9/11 on Sunday. We remember all who perished that day, terrible day in the nation's history. Next week, we have CPI and PPI, and we'll have that to report to you because they're important numbers. We hope everybody has a nice weekend.
Thanks, Moose. Don't forget to like, comment, and subscribe so you can follow along. If you have any thoughts or questions, put them right into the video, and we'll try to get to them next week. Enjoy the weekend.